Hey, everybody. Welcome to another podcast by Touchstone Financial Education. My name is Elliott Cox. I'm the Chief Content Creator here. And it's been a while since we recorded a long format podcast, so I've got a lot to get through today. But before we do, I'd like to get a little business out of the way. You can check us out at touchstonefinancialeducation.com. This is where we post these videos as well as our podcasts. And you could reach out to us, by the way. Send us an email, tell us what you think. If you have any questions or would like something addressed, by all means, let us know. We'll respond to you within 24 hours. And by the way, I do incorporate what my listeners and what my clients want us to discuss. So, again, if you'd like to hear anything, please give us a shout out. Also, you could check us out on Facebook on our page, Touchstone Financial Education. Same thing on YouTube. Please go like, subscribe, share, and follow. We really appreciate it. Thank you to all our longtime listeners, and welcome to you new folks. Now, today we are going to be talking about the markets, a few particular stocks that I've been watching, and some taxation on your brokerage account. So this won't be a discussion on IRAs or 401ks or 403bs. This is going to be about taxable investing today. So let's go ahead and get started. We are now in early June and we are suffering from, or I should say the markets are, a little bit of that summer malaise. I'm sure some of you have heard the old adage, sell in May, go away. And what that refers to is that the markets kind of take a breather this time of year. That's not indicative of performance of your funds or your stocks. It's just what happens in the market because folks are getting ready to take off for a vacation. They're not focused on the markets. So, what do you do with your extra cash, or maybe you're looking to change a few positions? That's what we're going to discuss today. So, let's get started with high yield or money market accounts inside your brokerage account. That's a great place to let your money sit because many money market accounts, as well as high yield accounts attached to those brokerage accounts, are earning well above 4.5%. Some are pushing 5. So it's a great place to park that cash while you are looking for ideas, especially in and around those sectors that have run and might be pulling back currently, like, of course, good old fashioned technology. With the AI push we're seeing, there's a lot of opportunities to get into AI plays. And by the way, ladies and gentlemen, AI, artificial intelligence, is pretty much ubiquitous these days. Everybody is in the AI space, but we are looking for players that are designing platforms or part of their product and service in and around an AI play, such as Palantir. And I've mentioned them before. Believe it or not, Intel. I'm going to circle back to Intel later. I know they've been beaten up. They haven't kept up with the NVIDIAs and the AMDs, etc. But we're going to go ahead and discuss that as well. So as we're waiting for those opportunities, make sure your cash is sitting in a high yield savings account. Get at least that 4.5% on that money while you are doing your research. Now, the reason I mention Palantir first and then Intel second is that both are moving heavily into providing services, products in the AI space. Palantir is a company that provides cybersecurity. They're a big government contractor. As a matter of fact, half of their revenues come from government contracts. So that kind of makes them recession proof. And I find that interesting. So that as we see volatility in earnings from certain tech companies, it's not going to be as volatile through the likes of Palantir, who's a newer company, by the way, but it makes for a strong background because they have almost a guaranteed source of revenue. So it's something to look out for. And one of the things I like about Palantir as well is that it looks like they might be added to the S&P 500 this year. What that means is that all of those index funds tied to the S&P 500, like VFIAX from Vanguard or VOO also from Vanguard, any S&P 500 fund will have to add Palantir. So what does that do to the stock price? Well, it's going to take it from the low 20s to wherever it's going to go, but it'll be a lot of upside because they have to have it. On top of that, their earnings have been strong And it looks like once the market begins to turn around, once we get out of the summer malaise, they're going to be taking off. So that's something to look out for in the AI space as well as cybersecurity. And I mentioned Intel. Now, Intel made a few missteps a couple of years ago. They are not competing with the likes of NVIDIA and AMD, excuse me, for these AI chips, but they are catching up. They are building out a new foundry up in Ohio, somewhere near Cincinnati, and also in the Northeast. And they just came out with a news, oh, what do you want to call it? News release, excuse me, that says they're in the process of working on a chip that will compete with NVIDIA's chips. Now, just so that you know, in the chip space, it takes a very long time for the product to cycle, meaning from testing or creation to testing to getting that chip out in the market. So we might be looking out a little ways before it takes off. But when we're looking for great investments in any sector, we don't want to buy them when they're already high. We want the things that have been beaten up and are low. So if you have a buy and hold perspective and you like AI and you still think chips are strong, like I do, take a look at Intel. There might be a great opportunity for that investment again with a buy and hold strategy. You traders, well, you're going to do what you're going to do with that. But as a buy and hold, Intel is back. Remember, just because Intel's been out of it for a few years does not mean they are out of the game completely. As large as Intel is, they will be back. And for those of you with the patience, who like fundamentals of a company, meaning how much they earn, how much revenue they're bringing in, please take a look. Now, one other sector I like to bring up here is healthcare. As this bull market expands, yes, we're in the middle of this summer malaise, but as the bull market expands, because we are in a bull market now, healthcare is an excellent play. Do I have any specific stocks? No, but there are wonderful healthcare ETFs like XLV that will allow you to take advantage of the expansion of that healthcare sector. And the reason I mention it this way, meaning a bull market is expanding because technology, which has reigned supreme for a long time, is not going to be the only sector that wins through this bull market cycle. Healthcare is another one. So, again, if you've got that buy and hold strategy discipline, take a look at healthcare stocks or ETFs. It would serve your portfolio well. As a matter of fact, I would say between the Palantirs, the Intels, some healthcare ETFs, a great way to get into these sectors and particular stocks is through dollar cost averaging, meaning you go ahead and put a little bit in every month, much like you do your retirement account, so that you could take advantage of any dips along the way because there are dips in a bull market. Bull market doesn't necessarily mean that the market goes straight up, but it does mean that it is in an upward trajectory and there are some selling that goes into it from time to time, but overall the markets are headed higher. And this kind of segues also into the Federal Reserve lowering interest rates and what the markets will look like. The Fed still said they are going to lower rates later this year. It's not going to happen in June. We know that, but later this year, maybe as early as September. So all of these forces are working to affirm the bull market. There are great opportunities in artificial intelligence, cybersecurity, and chips. They're still on the table. You haven't missed the boat. Do your homework, dollar cost average, and I think you'll be impressed with the performance that you see. Now, the last thing I want to mention on the investment side today, ladies and gentlemen, is China. China has really had a hard go of it the last 4 or 5 years as well, mostly due to a crackdown by the communist government on publicly traded companies that we have access to here in the West, specifically the United States. We know that. They've also had problems with a glut in real estate inventory. Well, guess what? A couple of weeks ago, the Chinese government made a statement that basically said they have corrected the problem in their real estate market and the Chinese stock markets are starting to respond favorably. Here's the thing. The Chinese government does not usually make those kind of comments. They did not recognize that the world knew there was a real estate issue in China. There was just no recognition. And so it's funny to hear them say the problem has been corrected. I interpret that as an opportunity to look at China once again, whether it's ETFs or particular stocks. You can go wherever you like in China, from EVs to other electronics to online retailers, whatever it is, start taking a look at China. And me personally, I'm not going to try to pick any Chinese stocks anymore. Been there, done that, and got the t-shirt. I would say this, take a look at ETFs in China, whether they be broad-based indices or specific sector funds. And what that means is if you like Chinese EVs or if you like chips or telecommunications, whatever it may be, go ahead and look seriously at placing some money there. It's been a long time since I've discussed emerging market or international stocks, but it's time to start taking a look. And by the way, the difference between international and emerging market is that emerging market is the second and third world, which we still consider China to be a part of. I don't know why, but we do. International is first world outside the United States, Australia, European Union, etc. So, again, to circle back quickly, please eyeball China once again. There's some opportunities for a nice buy and hold strategy while we are still in the bull market. And let me back up just a second. When I say bull market, that's when the market goes up, usually over 10-year increments. Bull markets kind of they last about 10 years. And if we go back to the year 2000, the tech bubble burst, and then come '07, '08, the housing bubble burst here in the United States, but it didn't impact the stock markets until about 2010, and then they bounced back late 2010, early 2011. So there's a 10-year period there. Then in 21, the market started to pull back, right? We had the pandemic. And by the way, if you look at a chart of the S&P 500, the NASDAQ 100, the Dow Jones Industrial Average in March of 2020, you'll see a nice deep V. So that kind of ended that bull market from 2010 to 2020, and now we are off to the races in a bull market that started late 21, early 22. So we've got a handful of years in this bull market. So when I'm mentioning cybersecurity, artificial intelligence, chips, China, maybe some retail stocks, which I'll get to in another podcast, this is the time to take a look, take advantage of these opportunities. You might even want to be a little more aggressive than you usually are in your brokerage account. That's the taxable investing account. It can be used for retirement, but this is an account we use for interim goals like buying a home, taking a vacation, etc. And this is an excellent segue into taxation on these accounts. There's basically three types of taxes associated with a brokerage or taxable investing account. They are short-term capital gains, long-term capital gains, and dividend income taxes. Now, short-term capital gains, if you buy a stock and you hold it less than 12 months, less than a year, you'll get hit with short-term capital gains. And that's your income tax bracket, whatever that may be. Now, if you're in a very high tax bracket, of course, be careful because that can bite you, but you will still make money nonetheless if you're investing appropriately and wisely. Long-term capital gains, ladies and gentlemen, is any position that you have held 12 months and 1 day. So basically longer than a year. If you hold a position 12 months and 1 day, you will pay on your gains a rate of 15% of the profits. Again, 15% of the profits for long-term capital gains. That's not a bad deal. So the government incentivizes a buy and hold strategy from a tax perspective. So as we're talking about these positions and we're still in the middle of the bull market, please consider holding your positions that long. Now, if you made a boatload of money in the short term and you're not afraid of paying those taxes, great. Go ahead, pull the trigger, get out and find a new position. But know that the government incentivizes at a 15% long-term capital gains tax rate. And most of you folks aren't traders, so that would play to your benefit. The last one is the dividend income tax rate. Now, some of you have heard that Warren Buffett often talks about how he pays less in taxes than his secretary. That's because he lives on dividend income. And the rate he pays, the rate you will pay on your dividend income is 15%, much like long term capital gains. And by the way, that is lower, or I should say, it's one of the lowest tax brackets, if you will. So, dividend income is a positive, especially if you're getting closer to retirement, even in a brokerage account. And know that whatever dividend income you earn, you will pay 15% in taxes on the cash that hits your account. Now, on the flip side of this, if you have some losses, if you're looking to get out of some of your losers and into something else, you get to write off up to $3,000 per year in capital losses, right? So let's say you have a capital loss of $5,000. You can take $3,000 this year in 2024, and guess what? The other 2 grand carries over into 2025. So basically, you do not lose these capital loss opportunities. Again, $3,000 per year only, but they do carry forward until those losses are completely written off. So there are some incentives there to go ahead and bite the bullet, get rid of your losers, and look for other opportunities, especially second half of this year. Like I said, artificial intelligence, cybersecurity, chips, healthcare, and China is what I'm looking at right now. Hey guys, thanks for listening. Again, you can reach us at touchstonefinancialeducation.com. My name is Elliott Cox. Oh, you can also find me on LinkedIn under the same name, Elliott Cox. I like to see the people who listen. It's kind of fun. And again, if you have any comments, please reach out via LinkedIn. Go to the email page on our website, and also you'll find our other podcasts on the website as well. And please don't forget about Facebook and YouTube under Touchstone Financial Education. Love to hear from you there as well. Please like, follow, share, and subscribe. Until next time, thanks for listening.